Okay, welcome. This is Lab 6.1, and it's a FIFO question, and there's a schedule provided at the bottom. You can use that if you like for calculation purposes. I'm not going to use that schedule because I think we can do the calculations fairly easily in the tables at the top, but if you want to use it, by all means, go ahead. So we are calculating the cost of goods available for sale, so that's beginning inventory plus purchases during the year, and then the number of units available for sale and the units remaining in ending inventory. So the cost of goods available is going to be the 300 times 22, the first beginning inventory amount, plus we purchased 200 at 21, plus another purchase of 100 at 19. So the total cost of goods available for sale is 12,700, and that's calculated as shown here. The units available for sale is just the 300 plus the 200 plus the 100. And if we take those units and subtract the two sales, one for 200 and another for 200, we end up with 200 units remaining in ending inventory. So the units available for sale, 300 plus 200 plus 100, to beginning inventory plus purchases. Take that and subtract the two sales, and that's how much is left in ending inventory. Our cost of goods sold under FIFO is the oldest material is sold first, and the newest material is in ending inventory. So we have 200 units in ending inventory. We had 600 available for sale, so the 400 units that were sold are the oldest 400 units. So we can take the 300 times 22 and add 100 of the $21 items, and that's 8,700. Ending inventory, ending inventory will be the newest 200 units. So it's $4,000. The gross profit, we sold 400 units, and it says that the price for all of them, the selling price was $2,500 or $25 each, and we sold 8,700 worth of material, so we made a gross profit of $1,300. Now we're preparing journal entries over here. We have two to do. A is the purchase, and B is the sale on October the 15th. So let's do the September 9th purchase first. And okay, jumped right to the calculation. So here we're recording the purchase on September the 9th. So we have 100 units at $19 each. And of course, that's the same value for both the debit and the credit. The debit goes to merchandise inventory, right there, and the credit goes to cash. Now, I tried it with accounts payable and I got it wrong, so that's why I'm redoing it. So use cash because we're assuming that they're purchased for cash. So yeah, right up here it says in the sentence, assume all purchases and sales are for cash, and I didn't catch that. So I'm saving you a little time for that. On the 15th of October, we made our first sale. Actually, that's our second sale. Our cash would go up by the amount of the sale, 200 units at $25 each. And the other half of that entry is going to be sales, of course. And that is transaction B. Okay, jump even the mouse here. And then the date for the other half of the transaction, the cost of goods sold, and merchandise inventory going down. That sale was 200 units, and it was 100 units from the opening inventory, plus another 100 units from the January 29th purchase at $21. And that's also part of transaction B. And I think that's everything. So let's see what Lyric's thought. Lyrics agrees, and we're done.